All right, I think we're going to get started. Thank you, everybody, for being here today. We are going to talk about all things microcap, where 2025 has taken us, and hopefully where 2026 will go. Before we get started, I would like the panel to just introduce themselves. We have a great group of individuals here who are very experienced in the industry and have done a tremendous amount of deal flow. So let's start with Ross, and then we'll get right back into the data because we got a lot to talk about today.
Thanks, Joe. For those who don't know me, my name is Ross Carmel. I'm a partner at Sickenzia Ross Ference Carmel. I'm the Carmel, not the Ross. Nice to meet everyone.
Hey everyone, Matt Bernstein. I'm a partner at Alnoff Gross and Mernshaw.
Stephen Lambrix, I'm a managing director at EY. I sit in our capital markets group, focused on all things capital formation related. I've been at EY for a few years. Before that, I was an investment banker for 20 years at Deutsche Bank and PJT Partners. So I basically spent my entire career working on things like IPOs, de-SPACs, direct listings, private capital, and continue to do the same sort of advisory at EY.
Hi everyone, my name is Gaurav Verma. I co-head the banking efforts at DeBarral Capital. I think I know a lot of you here in the conference. So prior to DeBarral, I was at Demora for about 6 years, BofA for about 8 years, and then Citigroup for about 5 years, a TMT banker for over 2 decades, and kind of co-head the banking efforts at DeBarral Capital. And we're heavily focused equity market shop across SPACs, IPOs, pipes, follow-ons, etc.
Thank you, gentlemen. And for those of you who don't know me, my name is Joseph Lukoski, and I am the managing partner of Lukoski Rookman. We, much like Ross and Matt, are a securities boutique here on the East Coast, and we are very hyper-focused in the micro and emerging growth markets. Today, we're going to talk a lot about data because we believe using and cultivating data from the microcap industry can help us learn from it and make better decisions going forward. At my firm, Lukoski Brookman, we have a data desk which looks and tracks and curates and analyzes every microcap, IPO, uplist, cross list, and direct listing that hits the emerging growth market. So we take that data, we put it out to the industry, and then we try to serve the community better. So we're going to talk a lot today about data and moving forward. Let me just go over a couple topics quickly that we are going to cover so we can have a little bit of a roadmap. Then we're going to jump in because we have a lot to talk about. Before we get started, once we cover a topic, if there are questions, I know this is a little bit unconventional, we're happy to take questions in the middle of the panel. We don't have to wait to the end. We will try to get through all the data though, make sure we can cover what we have come here to cover. And at the end, we can have some more questions. So please raise your hand if there's a burning topic. You don't have to wait until the end. So we're going to start today talking about the last 6 years quickly of the microcap and emerging growth space to understand sort of where we've been so we can figure out, hopefully, where this industry is going. We're going to talk a little bit about the current state of the emerging growth space, deals, structures, a little bit of analytics. We're also going to cover all of the new regulatory challenges that I've talked to so many of you about, and we've spent the better part of a week preparing for coming out of the NASDAQ and New York Stock Exchange that directly impact emerging growth space. We're going to talk about 2025, not just in terms of emerging growth IPOs, but also what we call the year of the digital asset treasury deal. Over 200 deals in that space that has really redefined the emerging growth market. We'll quickly cover some alternative listing pathways because IPOs aren't necessarily the best or most efficient way to go. And then we're going to ask the panel for some predictions for 2026. So let's just jump right in. And again, happy to entertain questions as they come up. Let's talk quickly about the last 6 years, then I want to get the panel's reaction. So in order for us to understand the marketplace today and understand, I think, where it's going in 2026, we need to just see where we've been over the last 6 years. So, as everybody knows, 2020 was the year of COVID. The first 6 months of that year were very tough, difficult. Deals weren't getting done. And then the last 6 months of 2020, the industry really took off. Deals started to percolate,
And in 2021, that was the year that we all remember. The best year of sort of the microcap industry in recent memory. We call that the hockey stick year. That really carried over into 2022, the first 6 months, which we call the chugging along phase. And then something happened which really started the new regulatory regime in the microcap market in August of 2022. NASDAQ took a pause, microcap pause, and that really put a damper on deals. Some new rules came out. 2023 was the year defined of less is more. Less deal volume, less activity, less pricing, less dollars. Came into 2024, which we saw a lot of regulatory changes. Market took a little bit of an uptick, which brought us to 2025, which really is the new landscape. New rules, no regulatory regime, and the emergence of the digital asset treasury transactions, which really has redefined our space, and we're going to talk a little bit about that later. Before we jump in, I'd like to start with you, Garv, because you are the true investment banker on this panel. And you've seen good deals, you've seen bad deals, you've seen everything in between over the last 6 years. You were in the trenches just like all of us during this period. What has the last 6 years sort of told you about the microcap business, both on the deal side, maybe the regulatory side, and how do you equate that to what's going on today, and more importantly, where we're going in 2026?
Great question. I'll leave the regulatory piece to the lawyers and the experts here, but from a deal perspective, obviously 21 was a phenomenal year. Every sort of deal was getting done. IPOs were oversubscribed. SPACs were flying. I think we've had more SPACs that year than any other year. Follow-ons, there were huge demand. And then 22, the market turned around. IPOs slowed down. A lot of deals were not getting done. SPACs slowed down because a lot of the sponsors that did SPACs in 21 were just not able to successfully close deals. They didn't know what a SPAC asset class was, but just did it because that was the craze, right? So we saw 22 as a year of downturn in terms of deal flow, but 23 things picked up, 24 got better, but I would say in 25, especially over the last year, we've seen again a massive tick up on SPACs, specifically on SPACs. We're seeing higher quality sponsors come back because they understand the asset class, they know what's required from a target to get a deal done. They get a good deal done, and these have been trading much better, which kind of removed a lot of the bad jargon around SPACs being bad, because these deals are trading better now. So that's one huge difference. On the IPO side, I would say with the most stringent requirements from NASDAQ and even NYSE, we're seeing better quality issuers go public that have done some private raises before, are more stable, have a better financial profile to go public, and can actually handle the cost to stay public on the NASDAQ or NYSE, which is a pretty expensive endeavor on its own, right? You need 5 million plus or so of capital just to stay public. So we're seeing better quality deals get done. And with that, investors start deploying more capital on these issuers where they know it's a stronger profile issuer with much stable business, strong growth profile. So we're seeing more demand from investors, both for IPOs, definitely for SPACs, because these are better quality sponsors and are doing better deals. And then for follow-ons, you'll always see creative structures. So over the last year, you saw a lot of DATS deals get done because of all the hype in crypto. These are all financial engineering tools where you use a shell to kind of raise capital to deploy in crypto. So you saw a lot of that over the last year. That has again slowed down with crypto down. But there'll always be new flavors of structures in the microcap space that investors come up with. Issuers don't mind because it does give them a lot of capital. So we'll always see creativity, and we're still seeing pretty active market from investors.
And we're going to talk about the better quality issuers and why we think that is, because we have some data points on that I think are fascinating. By the way, on the slides on the right and left are the data points we're going to be putting up. So if you're sitting in the middle, I think to the sides. Unfortunately, there's none here in the middle. But maybe Matt
Joe,
or
can I tack on to that?
Yeah, please go ahead. Yeah.
Yeah, so I totally agreed with everything Gaurav said. I think one point that I would sort of bring into the mix to that narrative is around the cost of capital. I think the reason why, or one of the major reasons why 2020 and 2021 were so active in terms of capital formation, again, whether it's IPOs, SPACs, follow-ons, whatever the sort of flavor of capital formation is, 2021 was by far and away the largest and most active year on record.
But we were also in a cost of capital environment where, money was essentially free. Fed policy was extremely accommodative, capital formation was efficient. That obviously changed as we moved into 2022 and over the course of the next couple of years. I think, we've had a couple of Fed cuts recently, a little bit unclear as to exactly where we go on a go-forward basis, but I think a lot of the momentum that we saw last year in 2025 and the resurgence of activity I don't think it's coincidental that happened when we've got a more accommodative stance from the Fed. So I do think the cost of capital element and some of the fundamental dynamics in the macro played a big part in some of that 6-year narrative.
Before we get to Matt and Ross real quick, I do want to just point something out. See, I'm so glad you said that because you said 2021 was the most active year, which, up until this point we would have agreed with. And I think that's what the general industry does believe. Everybody's yearning to go back to 2021. But I will show you, wait till we see the next slide, the data doesn't support that. And we're going to talk about why in a second. But it's very, very fascinating. But Matt and Ross, do you want to chime in here?
Go ahead. Yeah, I mean, look, I more or less agree with everything that's been said so far. 21, even midway through 20, by the way, which is when sort of the hockey stick really started, and through 22, NASDAQ pause were incredible time to be in the marketplace. What I think, perhaps, the next slide will show is that 2025 actually was quite a productive landscape as well. From a regulatory perspective...
Thanks for spoiling it, Matt. Okay, it's okay.
I think that what we've seen is, and I don't want to jump ahead too much, but the SEC has been, over the course of this period of time, if you sort of overlay the way that the deals have been happening and sort of the policy, the SEC has taken a hands-on approach, especially with respect to SPACs in the 2022 range, then seemingly taken a hands-off approach, which has led, I think, to this most recent rise.
Yeah, let's go to the next slide because I think we'll get Ross's opinion on this. But look at this slide. This slide is the most popular slide in the emerging growth space. It basically puts on one sheet of paper the entire emerging growth and microcap market over the last 5 years. And if you look at that first category, you'll see in 2021, which again, I agree was an amazing year and it felt good. There was 108 emerging growth IPOs coming out of the microcap space. In 2025, there were 134. I mean, there's some real percentage gain there. Now, I think what we need to talk about, and maybe Ross will get your thoughts here, is why didn't it feel as robust and as euphoric as 2021, 2025? And I think the reason is because if you look at all of the other data points, deal volumes might have been up, but average prices, amount raised, were all down. So while activity was up, we still haven't gotten back to the heyday of 2021 where $3.5 billion was raised in the microcap world. So we had more deals in 2025, but collectively, they barely raised $2 billion. Maybe Ross, you want to give us your thoughts?
Yeah, I mean, I think what you're going to see, and I assume it will be coming up, is that the difference between 2025 and what occurred in 2020, 2021 is the foreign private issuers going public last year, right? So how the world has changed and why it doesn't feel like Joe was alluding to, it doesn't feel like 2021 and 2025 is because the majority of those IPOs were foreign private issuers, not domestic companies, and in those deals, they typically bring directed orders, meaning that they are bringing in the capital from overseas in order to then fund those IPOs. Very different than 2021, when the Fed policy generated liquidity in the markets, and institutional investors were coming into more domestic companies.
By the way, you can tell we did prepare, we didn't rehearse because the next focal point is on foreign private issuers. Thank you, Ross. Stephen said something earlier in the panel, which was, why do companies feel better this year than years past? And I think it's because of what Ross mentioned, the foreign private issuers that have come into the emerging growth space. And by the way, massive percentage, 101 deals out of 134 were foreign private issuers. That's a massive, massive percentage of the microcap market coming from abroad and mainly from the Asian region, usually incorporated through the islands down south. We're going to get to that in a second. But I think, to go back to Stephen's initial point, these foreign companies have generally had bigger balance sheets. Some of them have been net income positive. We'll talk about that new rule change in a second. They've had a quicker pathway to either cash flow positive or net income. And that is why the companies feel different. What we've been talking about is really trying to find domestic companies that can go back and overtake this market like it was in 2021. If you look at the slide, foreign private issuers only made up 31 deals out of 108 in 2021. So the whole market has shifted. In 2021, when capital was flowing, euphoria was in the market, it was all domestic deals, very few foreign private issuers. Then the market got challenged, and investors were looking for bigger balance sheets, closer runway to net income, and it flipped to foreign private issuers. Now NASDAQ changed the script on all of us, and we got to go back to the drawing board because everything is a lot tougher. Let's talk quickly about the foreign private issuers here. You'll see this inversion just quickly. This was domestic companies over the course of the last 5 years. Again, look at 2021 if you want to focus in there, 72% domestic versus 28%. And then today, total inversion, 23% domestic market share in the microcap industry and 76% to the foreign private issuers, which goes to their point of stronger balance sheets, bigger companies invading the markets because that's what the markets wanted. Do you guys have any comments on the jurisdictional challenges here? I mean, you look at these companies, and by the way, if you look at these registration statements, you look at this data, you won't be able to tell because you see companies, Asian companies, either in China, Hong Kong, Singapore, Malaysia. Most of these companies, though, are incorporated or have some sort of structure out of the Cayman Islands. If you really looked at just the data, you would see Cayman Islands as the most prolific microcap issuer. But there's no operations in the islands. You have to sort of sort through and pick up the data.
And Joe, just one point on that. I mean, just on Cayman specifically, I mean, a big factor for that is the SPACs, right? Because of the excise tax reasons, a lot of the SPAC sponsors started domiciling the SPAC entity in Cayman or BVI. So I don't know what the breakup there is, but a lot of the SPACs are predominantly now in Cayman. There's barely any in Delaware, Florida, et cetera, unless there's specific reasons, but I'm sure that has a lot to do with it.
It definitely has a lot to do with it. They're the ones who really started the trend. Now, this data doesn't include SPAC IPOs. It's true operating IPOs, but your point is well taken because the SPACs are the ones who really started that, and the operating companies are the ones that followed and continued the trend line. Let's talk quickly about another topic that has been really important, and maybe, Ross, you can give us your thoughts. Years ago, we used to do deals where we could raise $5 or $6 million. We would have selling shareholders that would come in and fill the other 7 or 8 to get to 15 public float. NASDAQ has gone away with that. And the trend line has been up and down depending over the years because, again, we're going to talk about new rules and net income exceptions. You can hear all these fancy terms that are no longer available. But maybe give us your thoughts on just how that process has played out, why selling shareholders are no longer viable to be used, and you really have to have now a straight $15 million IPO or more offering to get listed.
Yeah, I mean, listen, I think NASDAQ was first to the table as it relates to $15 million capital raise in order to fulfill the $15 million non-affiliate public float requirement. New York Stock Exchange now has its proposed rule out there, which will match NASDAQ's rule. And I think the intentions are, from a NASDAQ New York Stock Exchange perspective, they see that as a way to filter out maybe less mature, less revenue generating companies from getting the ability to list on one of their national exchanges because we've also seen, frankly, an influx of delistings. And I think they're trying to curb that from the outset, making the standards harder in order to filter out some of these maybe less mature companies.
Yeah, no, that's absolutely correct. And I also think that, you know, NASDAQ has done a lot of analysis on first day trading, first week trading, and a lot of manipulation analysis. And what they found was, not saying we agree with this data, but what they found was when the IPOs were smaller and the selling shareholders were a bigger part of that $15 million float, the stocks had a potential to trade in a more volatile fashion because the IPO investors had a cleaner runway where maybe the selling shareholders who were legacy holders weren't always willing to sell or sell so quickly. And it created this volatility that really made NASDAQ a little bit nervous on first day, first week trading, and you see these big volatile spikes. That's on the selling shareholder point, but that is no longer available. Now in our world, our emerging growth world, you must raise $15 million minimum from gross proceeds of an IPO to even get listed on the exchange. That's a new rule. Let's talk now a little bit about the sort of shifting landscape, because really beginning back in 2019, but more prevalent in 2024 and 2025, NASDAQ and the New York Stock Exchange have come out with numerous changes to their listing guidelines, which really impact, you know, not just the primary markets of IPO, direct listing, uplist, cross-list, but the secondary markets, because as less companies get listed, there's going to be less secondary deal flow. So if you look here, 2025 was really a year of shifting the landscape and regulatory change within NASDAQ. Quickly, I'll just walk you through the narrative, and then maybe Ross and Matt, you guys can jump in here. Started last year around the holidays, 2024, when NASDAQ came out with this $15 million gross proceeds rule. If you list on NASDAQ, you have to raise $15 million unless you have net income. That went into effect in April. Then they changed their mind again in September and said, hey, we don't like the net income exception anymore. Even if you have net income, now you have to raise $15 million. So they got rid of that exception. Then they came back and said, well, if you're an Asian company, well, you got to raise $25 million. Then they weren't done. They came back and said, most recently in December of this year, that if you were listing, especially from a foreign jurisdiction, even though this applies to domestic companies, we're going to put you through a discretionary analysis. And we're going to look at a combination of 9 factors: who your bankers are, who your advisors are, where do you sit, what country are you operating in, do your executives and board members have experience here in the U.S. capital markets, are your home country laws tolerant to and abide by enforcement procedures here in the U.S. And that has really thrown the listing process into a frenzy, which we're all trying to still sort out as practitioners. Maybe, Matt, you give us some of your thoughts on that process, because I know you have been just as frustrated as some of us on the listing side in trying to get these deals through and communicating with the exchange.
Sure. Yeah, no, and it's been extremely frustrating for many of the issuers that we work with, especially those that are who are in basically limbo, in purgatory, waiting to hear from NASDAQ, but not sure whether they are going to get approval, even though they've met all the listing requirements and have also cleared SEC review. You know, I think a lot of it is, it seems at least to me, to be a reaction that's a little delayed, right? Because we had in January the SEC come out talking about making public great again, right? Having, you know, easing disclosure requirements, making it cheaper and easier for companies to go public, while at the same time having NASDAQ and NYSE come out with these new rules, not only, by the way, making it more difficult to go public, but also contemplating new rules to make it easier to delist, right? So you've got these two conflating objectives that seem to be occurring at the same time, which, you know, it's hard to say what we're going to see in 2026 for that reason. You know, I think some of us are optimistic that now that some of the newer rules are officially effective, in particular the 15 million for a net income company, that NASDAQ will move a little bit quicker on some of these companies that are in purgatory right now, but it's really hard to say, unfortunately.
You know, Matt, you make a great point. You know, I didn't even think about that, but I have spoken about this a lot. the SEC came out saying, make our markets great again, and then we're going to ease the burdens, and we're going to make it quicker and faster and more efficient. The problem is the SEC is not the issue. It's been the exchanges. I think, the administration, whether you love them or not love them, they need to speak to the exchanges. It's not the SEC, it's the exchanges that are holding up the formation of capital, especially in the emerging growth space. And I do encourage, all of the regulatory bodies, NASDAQ, New York Stock Exchange, the SEC, FINRA, DTC, OTC, to work together, because this is the most vibrant part of the market, the emerging growth space. I'll just say one other point on the differences between NASDAQ and New York, and Matt mentioned it, but maybe Ross, you can comment on it. My view as a practitioner being in the trenches every day with these exchanges is that, the New York Stock Exchange is very upfront. They either like you or don't like you right at the beginning. So, and they will tell you, you're not for us, thank you, go over to NASDAQ. Problem is, NASDAQ is the reverse. NASDAQ won't tell you anything. You will go through the process, you will spend the time, you will spend the money, you will expend all these resources, only to find out 9 months later that they don't like something, because of the communication is totally different between the New York Stock Exchange and NASDAQ. Maybe Ross and Matt again, and maybe Steve and you as well, can jump in and give your narrative of the differences in the listing application process, which is so dramatically affects what we do on a daily basis.
Yeah, I mean, I used to tell my issuer clients all the time when they're saying, hey, Ross, New York Stock Exchange or NASDAQ? And I said, well, listen, New York Stock Exchange is subjective and NASDAQ is objective. Meaning, New York Stock Exchange, they like your company, then they invite you to apply. Versus NASDAQ, the way it used to be, is, hey, if you meet our listing standards, we're happy to have you. That has now changed, right? And to Joe's point, New York Stock Exchange, you go to them, Paul Dorfman, you show them the slides, you talk to him, and he says, yes, we'd love to have you. NASDAQ, even with their new rules, which are these discretionary rules, where basically they can decide on a discretionary basis with, frankly, out any reason to you that they're not going to accept your listing, now is completely flip things. And at that point, because of how the NASDAQ process works, you might have cleared comments with the SEC, bankers might be ready to go, they could have submitted their allocation lists to raise you the capital, and then before you get the approval process, you hear from NASDAQ saying, sorry, we don't like the allocation of this deal, or we don't like the investors that are in this deal. And then after you spend hundreds of thousands of dollars on legal, auditor, and listing fees, you're now in the dark, or you're in limbo with no place to go.
I mean, I think deal qualification is a great point. We haven't even talked about that. We were just talking generally, Ross, the other day, just about discretion, whether they even like the deal. Yeah. They like management. They may not like your country of origin. That's how the process has changed on the discretionary path. But from my perspective, again, I think issuers and advisors need to know earlier in the process whether there is going to be a problem. And, I've spoken to people at NASDAQ, as we all have, and they've assured us under these new rules that if there is a problem, NASDAQ's going to tell us earlier in the process and give us an opportunity to cure. Now, we're not seeing that in practice right now, and I'm not hearing that coming out of the exchange, so that is in a developing area. But Matt, maybe you give us your thoughts, because just like all of us, you really do deal with this on a daily basis as well.
Yeah, no, I mean, I agree with what Ross said. We're in this place right now where it's, I think NASDAQ, look, I think at the end of the day, both of the exchanges now have a subjective element, which makes it more challenging to list as a general matter, right? So the question will be, are your advisors providing you with the information and insight at the outset to know exactly, what the risks are and what you need in order to give yourself the best possible opportunity to list.
And look at this, in 2026, right now, New York Stock Exchange just came out with a new rule, proposed rule, to match NASDAQ's $15 million gross proceeds rule, meaning if you're an emerging growth company, you must raise $15 million instead of 10, which was a nice little exception for the markets, for the last 1 or 2 years, where NASDAQ was at 15, New York is at 10. Let's quickly jump over to sort of this slide. We're not going to talk about this, but you can see how far back these regulatory changes have gone, really starting in 2019. And every year there seems to be more and more regulatory changes. in the marketplace. Let's jump to this slide because I think this is the most important and probably shocking revelation of this entire panel, and I think of this entire event. And that is, at the data desk we have at Lukoski Brookman, we track again every IPO and uplist, cross-list, direct list. We discovered the other day, our sort of data engineers, that there hasn't been a microcap pricing in the last 55 days coming out of NASDAQ. Not one microcap emerging growth company has been approved coming out of that exchange in 55 days. Whereas the New York Stock Exchange has approved 7 deals. This is the first time in recent memory, in 6 years of collecting microcap data, where the New York Stock Exchange has been blowing NASDAQ out of the water. And not just blowing them out of the water, there's a zero goose egg on the table for NASDAQ. And the question is this just NASDAQ getting their feet wet with the new rules and figuring it all out? Or is this really going back to August 2022? And are we in a new microcap emerging growth pause with the exchanges?
I mean, I think it's to be determined. I do believe, at least in my conversations with some of the NASDAQ folks, is that they are themselves internally navigating the new rules and the intentions that their bosses or higher-ups have in regard to the microcap world. So I think, right, and I know a lot of us probably are, especially if you're doing a foreign private issuer deal, we're getting the same email, which basically says, we've instituted this new rule. It will take us several weeks to review and get back to you. To me, they're buying time. They're trying to figure it out in order to have some kind of internal policy to move these deals forward.
By the way, I was going to say, if anyone from NYSE or NASDAQ is here, we love you guys all. So, disclaimer, all this is all subjective. But leaving that aside,
Yeah,
again,
if you're here, come on up. We got a lot of questions for you.
But leaving that aside, I think one of the key points is, NYSE's been around forever. NASDAQ took a lot of market share from being more lenient. With the 5 million being able to get out and get public, NYSE always had the 10 million from the very beginning, at least that's what I know. And then obviously that led to a lot of irregular activities with trading. They probably caught on to it and now are kind of mirroring what NYSE always had. And that could be, they're just catching up and, basically fixing the rules which should have been in place before. That's just my view. And now they're closer to what NYSE always had. So that's probably why there's a gray area where they do approve, do not approve. And at some point, they'll probably be similar to what NYSE has. So I don't know when that happens, but this uncertainty is obviously frustrating for us, for issuers, for councils, everyone, right? Because if we knew exactly what would be needed to get approved, we would do that from the very beginning or guide issuers accordingly.
Yeah, I'm just thinking this out loud, and I don't work at the NASDAQ, but I wonder if there's anything that has to do with, like NASDAQ has lots of different types of businesses. I know that they've been looking at the private capital markets as well and trying to provide more transparency and liquidity for private equity stakes in unlisted companies. So I wonder whether it's just a matter of prioritization and this perhaps puts a speed bump in place for them as they think about some of their other alternatives. I have no idea, but...
Yeah, I think they've had a rough couple years. I think they put in some new regulations going back from 2019, which they thought were going to help make the markets, smoother, if you will, less volatility. It didn't work in 19. It didn't work in 20. Didn't work all the way up to 23 and 24. And, I'm not sure if it's worked in 2025. The other thing I'll say is that, I think that they are trying to figure this out. They're not sure where this is going, but they just want to have efficient markets where, issues can come to market and they could efficiently trade. The problem is, in these emerging growth companies, there's not a tremendous amount of capital raised, and no amount of rules or regulations or metrics are going to fix the efficiency of a capital market. And that's where I think we have to keep our eye focused. We can legislate all we want, but the market is going to decide whether a company deserves to be there or not be there. And another hot topic really is, I see this all the time on LinkedIn and with some other groups in the emerging growth space saying, they're there's bankers and lawyers and consultants and everyone running around trying to convince companies to go public so everyone can make money. That is, in my view, an absolute misnomer. It's nonsense. If you've ever sat across from a CEO or a founder who is telling you that they want to grow their business, hire more employees, feed their families and their employees' families, and really elevate their life's work, no lawyer, banker, consultant, or anybody is going to stop them from going to the marketplace that will give them the capital to at least try to carry out their dream and execute their business. And there's been friction between trading platforms and the exchanges, whether this is, some sort of scam on the NASDAQ and the industry. And in my view, it's complete nonsense. Maybe you guys have a comment or two there, but I think this has also played a role in why NASDAQ is being so reactionary and prompting all these new regulations, one after another, again, trying to legislate market dynamics.
Yeah, I mean, I would just say, agree with all that. There's so many good reasons for companies to be public of all sizes and scales. You can also think about, ability to attract and retain talent with a publicly traded stock. You can think about it with respect to ability to affect an inorganic growth strategy with an M&A currency. So there's a ton of different reasons. It's not just access to capital to grow your business and provide monetization to existing shareholders and employees, but those are also good too. So I totally agree. You're not going to stop creative, hungry entrepreneurs of businesses that want to get a listed stock. And I guess I think it'll be interesting to see how this all plays out. I didn't realize the zero in the last 55 days. So if that trend continues, I think you might see some change in posture. Is my guess.
Not to scare everybody. We do think it's going to change. In fact, we have 2 listings we're hoping to get approved this week or next. So we're going to break that drought. But it is an interesting data point that, by the way, nobody can believe even today, but that's what the data tells us. It's been 55 days without an emerging growth listing. Let's switch quickly to 2025, the year of the digital asset treasury deal. I want to just talk about this separately because I think this had great impact on the emerging growth space and will continue to have impact. Even though those deals have slowed down, we're not seeing as many come to market, but the aftermath, the effects of those deals, over 200 of them in the crypto space that have come and collided with the emerging growth space and the microcap world, are going to play out in 2026. Maybe, I know Matt and Ross, you guys have done a tremendous amount of these deals too. Give us your thoughts on 2025, and more importantly, what does the aftermath of 26 bring us, how it affects the emerging growth space?
Sure. So 2025 was certainly an interesting year for the DAT strategy. I'm not sure, I assume everyone's familiar with it, but maybe not. But in effect, the concept being that you are acquiring a digital asset and going to engage with that asset moving forward as your new business, right, as a function, right? We saw a ton of activity in this space as crypto was hot, right, over the summer, through I guess, beginning in the spring, through the summer. As the crypto market has cooled down a little bit, we have been seeing less and less of these transactions. But 2026 will prove out to be a very interesting year for it, right? Because we'll see whether this strategy really works, right? We'll see whether these companies that have engaged with these digital assets are able to ultimately generate the income or generate the returns that they're expecting in order to create value for their shareholders.
And I think at a minimum, right, it provided some of these micro-cap, small-cap companies a way to add an asset to their balance sheet, which frankly just made them a stronger business. You see the slide that Joe has up. You had a company like Soulmate, who was a micro-cap company. They did their deal with Solana, and Cathie Wood was one of the lead investors into that transaction. So I think it really transformed the market. It also brought attention to this side of the market. I also think, to Joe's point, in 2026, I think as more deregulation in the crypto space continues to occur through legislation, that there's potential for, I guess, a more vibrant DAT market to reemerge. Because right now we're in a slow period, given the current status of where crypto is trading.
Yeah, very slow period, absolutely. Stephen and Garv?
Yeah, just to add to that, I mean, we've also done a few DATS deals. There were two buckets, right, where there were shell companies that really didn't have an operating business, used the shell to do a DATS deal. That's predominantly what it was. But there was a whole camp of other issuers that did have an actual operating business, used some of the proceeds for their working capital to grow the business, and the majority of it was, deployed to DATS. So those issuers are doing relatively better because they're still growing the operating business, versus the other ones that were predominantly DATS focused. With the crypto market down, altcoins all being down, they're obviously going to wait till the markets to come back, but the other businesses are actually growing. So
And here's the point that nobody really talks about. There was 200 plus DAT deals done in the emerging growth space last year. And I would say about 100 of them or more probably saved those NASDAQ companies from getting delisted. That is the undercurrent story that nobody is talking about. NASDAQ has worked so hard for years to get rid of companies that they believe no longer deserve to trade on the exchange. Then everyone wanted to copy the Bitcoin MicroStrategy process and bring that native crypto world to the emerging growth space by putting these digital currencies on, digital assets on these balance sheets. And then NASDAQ tried to implement new rules again to try to prevent that, which actually was saving companies from being delisted, thereby giving NASDAQ better statistics, better numbers, less delistings, less black eyes, less fighting with other exchanges about whether companies deserve to be there, less panel hearings. But that's the undercurrent. 100 or so companies were saved because of this digital asset strategy. Stephen, anything to add?
No, I think I just maybe observe that I think the digital asset treasury strategy works particularly well in the microcap space. I think less so, albeit with exceptions for some of the larger cap guys. There's only so many micro strategies out there. So I do think that it's a theme and a trend that we have observed as well, and I think it is particularly well suited for this slice of the market.
And I'll say one other thing that I think nobody is talking about is that right now, as Ross said, these strategies, some of them, a lot of them, aren't going so well. Crypto is really in a bear market, back in the bear market to some degree, and these companies are not trading well. A lot of times they're trading below net asset value, which is a problem. So I think that you're going to see a lot more reverse mergers coming into the emerging growth space. So all those companies, 200 of them that now have $100 million plus on their balance sheet, are going to function in some capacity like a mini SPAC. They have a coin, they have value, they have assets, they have cash, but they have an underlying coin that is not doing well, may never recover, maybe it has no utility. What do they do with those assets? Well, I think the emerging growth space is going to challenge the SPAC world, which I know, Garv, is your world, because now you have all these companies that are sitting on cash without a trust, without shareholder vote, can basically do whatever they want to reverse merge or acquire an operating business. So for those of you who are looking to do a reverse merger, I would start with companies who have done digital asset treasury deals last year and are trading below NAV. That's the first place I would look. Let's. By the way, Garv didn't like that. He's like, don't compete with my SPAC. Stop it. Stop talking.
Actually, that gave us more ideas. That was good. That was actually.
All right. Let's just talk for 3 seconds about alternatives. We'll get to predictions and we're going to take some questions. What do we think? Is the IPO going to be prevalent here in 2026, or are we going to see more, direct listings, reverse mergers, up listings, cross listings?
I mean, I can tell you what I'm seeing, directly, right? We are working on tons of reverse mergers right now. Lots of microcap companies who are looking to give their historical shareholders some value by bringing in a more robust operating business, and at the same time giving that maybe more mature company a faster path to the public markets. Similarly, right, we're also working on a bunch of direct listings. You know, we did three of those 3 direct listings last year. They're on Joe's slide, and we're working on several more. That is a great path for companies that have good revenue, growth, a large shareholder base of at least 300 round lot holders or more, in order to come to the public markets without actually having to raise any capital, provide their investors liquidity, and more importantly, once they're listed now as a NASDAQ, New York Stock Exchange company, they can go out, raise money to grow their business.
I could speak to the uplists, if that works. Yes. So I've actually been seeing a lot of uplists and cross-lists coming across the tape. The reason is, I believe in the parens, I can't quite read it, but one of the reasons for that is that it is an exception to NASDAQ's $15 million minimum raise rule. Yep. And so folks who are either listed on the OTC marketplace and are seasoned, so they have trading that's occurring on the marketplace, and it's actually not as much trading as you'd expect, or are trading abroad with a similar amount of trading, are able to list or apply to list onto NASDAQ with a smaller raise. Mm-hmm. And so we are actually seeing a fair amount of activity in that space right now, more than I've seen.
That is an excellent point. That is actually the lone exception. That's why we have it on the slide. It is the lone exception to the $15 million gross proceeds rule, both on NASDAQ and the proposed rule on the New York Stock Exchange. And we think that there are going to be a lot more uplists and cross-lists coming into the market for companies that don't want to raise $15, $20 million out of the gate. They want to list. They have some liquidity in the OTC. They have some good substance behind their business. I find that the exchanges, NASDAQ, and particularly New York Stock Exchange, have been very friendly and user-friendly on the uplist, especially if you have some liquidity. So for those OTC companies or companies that are maybe in a foreign jurisdiction, want to cross-list and they cross-trade on the OTC, that is a exception that we see is going to be an uptick in 2026. And coincidentally enough, in 2022, when NASDAQ got rid of the simultaneous reverse split and listing rule, that really killed the uplist market. But now we're starting to see it come back as the lone exception, as Matt has said, to the $15 million gross proceeds rule.
And again, I would just add, I mean, the form of going public is going to change. I think issuers are still going to go public. So to your point, uplist, reverse merger. SPACs are nothing but a reverse merger, right? So just to give you our example, we have 5 SPACs pricing this week, another 5 next week, right? These are going to be combining with issuers that could not go public via the traditional way, or don't have a shell or not an OTC, but still want to go public. So they'll do a merger with the SPAC to go public that way. So we're just going to see a variation of the form they go public, but I think still we're going to see a lot of issuers go public, and that's why you're seeing such a huge amount of SPACs get priced, because they realize there's a huge void for these private issuers to go public, and they're just a stepping stone for them to go public.
Yeah, I would just, I mean, our purview of the market, we see a lot in the way of traditional IPO in the forward calendar. We see a lot in the way of de-SPAC, actually. I think the uplist route makes a ton of sense. We see a little bit less of the direct listing candidates from our seat, but I do think it makes a lot of sense in certain situations. So yeah, I guess to your point, Gaurav, like the mechanism is going to change depending on the environment, but at least based on our sort of view of the pipeline and the backlog, we see healthy activity across most of these different.
All right, let's jump quickly to questions. Before that, 2026 predictions. Ross, let's start with you. 10 seconds.
The year of the reverse merger, whether that's through de-SPAC transactions or through Microcap or other NASDAQ vehicles. I think we're going to see tons of reverse mergers this year.
Matt?
If the SEC can manage to stay open for more than 45 days at a time, I'm actually quite bullish. I think that there's money to be spent out there, and I think that there's a lot of opportunity. So,
yeah, I'm super bullish. I guess part of that is just my background as an ECM banker. We have to sell, but I'm super bullish. I think I would just say so. There's obviously a lot of the public data out there around positive momentum in capital formation. At EY, we sort of attach with clients pretty early on in the life cycle as they're thinking about a capital formation event, as I'm sure you guys do as well, everybody up here. And I would just say, anecdotally, what you won't see in the public information, I can share that like the level of activity and the pace of dialogue for companies looking to get public is very, very high across our organization for whatever that's worth.
Yeah, and I agree. It's going to be, we're pretty bullish. It's not going to be 21, but I think 26 is going to be a phenomenal year. We're seeing a ton of activity across all different asset classes, follow-on, SPACs, direct listing we've been part of, reverse mergers. So, and there's a lot of dry powder on the sidelines just ready to be deployed. And we've seen that since the first 3 weeks of just the amount of deals that have been printed. So we're pretty bullish as well that it's going to be a strong year.
That's great. You guys are making me feel a lot better because I'm bullish as well, but I don't know if I'm that bullish. Let me give you my prediction. I agree with Ross. 2026 is going to be the year of the reverse merger in the emerging growth space with a twist. I think another underreported version of topic of the emerging growth space is what happened to all the legacy businesses in the 200 plus DAT transactions that occurred. So if you think about what happened, you had a NASDAQ company that either wasn't doing well or struggling or maybe not that great, took in all this money, changed their business plan to now manage digital currency. Those businesses still exist. I think a lot of those companies are going to end up in reverse mergers to compete with SPACs. And I think a lot of those underlying businesses, the ones that are valuable or salvageable or worth anything, are going to start to find a way to spin out of those DAT strategies. So I think there'll be the year of the reverse merger with spin-outs not far behind because they simply can't stay as an operational principle in those DAT companies that survive. Let's go to questions really quick. We have about 9 minutes. Wow, we have a lot of hands. Okay, we did a good job, guys. Or maybe we did a bad job. Let's start right here.
So I've noticed a shift where many IPOs are locking up everyone now. So even the minor shareholders with less than 5%. Do you think the exchange are actually favoring this like low liquidity approach to keep the price stable, or is this like trend just going to keep getting stricter of the non-insiders? And from your point of view, does this mean the market is prioritizing the price control over the actual trading volume?
So I think your question revolved around locking up existing shareholders, right, in order to provide price protection post-deal. And I think you're seeing a little bit, what I would say is that at least what I'm seeing, or at least what I think NASDAQ is doing, is they believe by locking up existing shareholders, it has less downward pressure on the stock, meaning the stock should trade better. And as a result of that, I think they believe that they're providing some kind of investor protection to the individuals who are trading in the marketplace.
Well, I would just add, right, the lockup agreements tend to be investor-driven. The fact that NASDAQ is no longer allowing selling stockholders to be part of the analysis for the initial listing criteria is slightly different, right? So the idea that an investor who's putting money into an initial public offering wouldn't want to be competing with an existing stockholder who might have purchased their securities at a much lower cost basis, that's sort of always been the case, at least, that I've seen. Right? I think what NASDAQ is doing here is just saying, we want to make sure that there's real interest in this company, and there's going to be real volume and real liquidity in this company when we list it. And so by requiring $15 million, as opposed to say 5 million or 6 million or even less, by using the selling stockholder component, they're sort of making sure that there's more interest in the company. And
yeah, I'll give you some history on this. This is a great question because in 2021, when the market was absolutely bullish, you couldn't find a deal with selling shareholders. The investment bankers didn't want them. Nobody cared. It just didn't matter. You were a selling shareholder. You were left on your own. Go clear your paper, sell your stock, but don't bother us here doing the IPO. When the market got challenged in 2023-24, the selling shareholders became the most popular game in town because everybody needed them to qualify for the $15 million public float. Now, what's happening is they're becoming, again, irrelevant. And I think what's going to happen is because the exchanges now say, forget selling shareholders, forget their value, forget how much they count as public float. You have to raise $15 or $25 million to list. We don't really pay attention to your selling shareholders. So I think what's going to happen now is the bankers and others are going to start trending back to locking up large selling stockholders to give a clean runway for the IPO to trade without having interference maybe from low-priced legacy shareholders that have been in the deal for a very long time. But the exchanges, they're not so worried anymore because you have to raise all the money from clean IPO proceeds.
And just to add to that, right? I mean, the other thing they're trying to do is make sure the company raises enough capital as going public, that there's enough one-year runway, so they're not going to do a toxic deal, debt desperate, and hurt the current shareholders that came at the IPO, right? So that's another reason why they ask you for what's your cash burn for the first year. Is $5 million really enough? I mean, certain sectors maybe not. If it's healthcare, you need a lot more to keep growing, right? So I think beyond obviously just the lockup aspect, they want to make sure companies are well-funded, that they can survive at least a year and not just go get delisted within the first 6 months or so.
Guys, with all of the delistings that are happening and the uplistings that we're talking about, or potential reverse mergers from OTC onto NASDAQ, if you had someone from OTC Markets that was here today, what would you say to them? How can they grow up and clean up their reputation so that they become a real viable alternative and a minor league for companies to move up to NASDAQ?
Yeah, that's a great question, Simeon. Thank you for asking it. I think there is a undercurrent in the business, and there's the quiet part that a lot of people are afraid to say out loud. And there's this tension between what is the OTC markets, what does it offer, really offer domestic, entrepreneurial, emerging growth, companies who are founders looking to grow their business. What does that platform offer versus what do the exchanges offer? And there's just been this tension throughout the last few years between the platforms. And the OTC has been very vocal about attacking NASDAQ for allowing companies to list that maybe in the OTC market's judgment weren't ready. I don't know who made them judge and jury, but this is what they say. So NASDAQ has taken an approach to try to maybe clean it up, partly because they're tired of being attacked, partly because they're regulated by the SEC, partly because they just want change and better companies. But it's a very, very good question. As far as what does the OTC need to do to, as you say, not me, not us, clean up their act so they're viable for real companies, one of the things that I've been talking about, and we've talked about, and I talk with my partner Lawrence Medalitz all the time about, is you can't do a banked deal in the OTC, a real firm commitment underwritten deal. That is the number one problem, I think, for OTC companies. So they're constantly doing private placements, convertible notes, all of these games, structured deals, where they're not getting the opportunity to bring in a real banker with real investors on a real prospectus and clear stock. To me, that's the number one challenge, that if the OTC can fix that, I don't think we'd be talking about NASDAQ and the New York Stock Exchange. We'd have a wonderful platform to really have emerging growth companies shine, excel, grow, and carry on their mission. I don't know how you guys feel.
It's petitioning Congress, right? It's getting state blue sky law exemptions, right? That's the reason, one of the main reasons it's hard to raise capital. You need to go to each state if you're on the OTC because they're not exempt from state law requirements for securities purposes. Also, Form S-3, not available unless you're over 75 million of public float. Why not allow the same IB6 baby shelf exemption for OTC companies, right? So if you can sort of create a pathway to make it less friction to raise capital, that's when it can become more attractive.
Mm-hmm. Ross is going to stay as Switzerland on this one. It is an important point. Listen, it is a problem in the industry, and I've encouraged publicly, privately, from speaking engagements on LinkedIn, private meetings, for all of the marketplaces, the OTC, the NASDAQ, New York Stock Exchange, to get together and figure out how to solve this problem. There's no reason, like Matt said, that the OTC shouldn't have the ability to do baby shelf. They shouldn't have the ability to do a banked deal. Those are real problems in the industry. But I think from a purely technical perspective, That is the main reason why companies have to get off the OTC. They cannot simply raise the kind of money they want to raise on the OTC. And I know that's unpopular. I'll probably get in trouble for saying it, but it is the truth. It's what the practitioners believe. It's what the bankers say. It's what we hear every day. Just many people don't want to say that quiet part out loud, but it's a great question. Thank you, Simeon.
You presented some very interesting data, and thank you very much. I wonder whether or not you have any additional data. You know, typically there's about a 6-month lockup period for insiders on the price of a share of shares ratio 6 months after the lockup period ends versus the offering price and where that trend is moving.
Garb, maybe take this one because lockups are really, bankers talk a lot about lockups and deals. But I think the question was, was the question, where does the price end up 6 months later if you're locking up insiders? What have you seen companies holding in their trading so when the insiders get to that 6-month point, that there's something left for them to, trade out of?
I mean, it's a great question. There's no perfect science, right? I mean, you like bankers technically do a whole valuation analysis, look at comps, see where the sector is, see where the multiples are trading, and you apply that to what the valuation of the company should be at IPO. You apply some kind of a discount to it, and then you take them public. And then if the company's solid, it has a real growth outlook, certain milestones that they could hit, you would expect the share price to be much higher 6 months out. And that's generally what, at my prior shops, that kind of was the proper, exercise that we ran on every deal, right? So with that 6 months lockup, shouldn't be an issue because you would expect share price to be much higher. So really, you're not as concerned. In the microcap, it's a little different in the sense that, I don't know if it's perfect science or not, but ideally it should be the same, right? Which is if the company is on the right trajectory, meeting its earnings, hitting those milestones, the share price should be higher. If the sector is hot, the multiple should continue to trade up. So then, the locked up insiders should not care as much.
Yeah, we don't track that data, but we're going to start tracking that data. That's a very interesting data point. I would venture to say that it's either neutral or slightly below after 6 months, because I think a lot of these companies are raising just enough capital to get public, grow their operation, and then they have to go right back to the capital markets. And that's the real reason why they're doing it, because they can't get money on the OTC. They can't get money staying private, so they need to constantly feed their growth plan. But while you do that, if you're not execute at a pace that the market deems that you should be executing at, your stock price will fall. And for some companies, they don't execute at all. So the stock price is going to even go lower. But it's an interesting data point on 6 months, and we'll look into it. Maybe next year we'll have the answer for you. Right here.
With respect to the reverse merger opportunity maybe this year, what do you feel is going to be the scenario with respect to NASDAQ's arbitrary or subjective determinations that they're using now that kind of affect the IPOs? Why would it not also affect their agreeing to a reverse mergers? It's both U.S. and maybe foreign private issuers that are looking to reverse into a NASDAQ traded company.
Certainly, we can't predict how NASDAQ's going to change their rules. Historically, we could tell already since they've now been changing them almost every 6 months. Currently, though, right, you have to meet the IPO listing standards if there's a change of control transaction, and almost every reverse merger results in a change of control transaction. So I think it's to be determined. I still, at least as of today, I think the path is there, the guidance is there, and if NASDAQ changes the rules, we'll all adjust, just like we have on every rule change they've ever done.
Yeah, and I think it's an excellent question because 2026 is going to be the year of the reverse merger. I also do think NASDAQ will apply those rules. It's 5101-3. That's the new discretionary rules if everybody wants to Google it or look it up. 5101-3. And I do think they're going to apply it to reverse mergers. The other thing I'll say about reverse mergers is Ross is absolutely correct. You have to requalify as if you were doing an IPO on the combined company day one of closing. The problem with closing a reverse merger on NASDAQ is there's no starting and stopping point. So the stock has to trade above $4 for this indeterminate period of time, usually 30 days, and then it becomes 40 days. And then you're just left chasing NASDAQ to figure out when the Nasdaq gods will look down upon you favorably and say, okay, that's enough trading. We agree. You can now close and list. So if they start applying, which I do believe they will, because remember, they're just discretionary rules to keep intact integrity of the market. I do think they will apply that to foreign companies trying to back end the IPO market through a reverse merger.
Before I ask my question, I just want to congratulate this incredible panel. And Joe, so many great insights. I mean, really impressive. With respect to all of these reverse mergers that have happened in like the last year or so, the trends that you're seeing, that you're speaking of for next year, if you look at, and this is a rough estimate, like last 6 months, what's the breakdown of like true 4-day turnaround reverse mergers with brand new unrelated companies as opposed to more strategic, almost acquisitions where there's a new operating company coming in? I imagine it's the 4-day, turnaround Super 8K. But I'm just curious what the breakdown looks like given this new environment and this new sort of opportunity for companies to see another way to get to an exchange.
I got some strong thoughts on that. So I not to dominate, you guys are free to jump in, but I do think that the days of the 4-day Super 8K, in my view, are gone. The SEC changed the rule 2 summers ago and said, look, if you're going to bring in a new operating company to an exchange listed company and spin out that old business. Now, if the operating business stays, like you said, more strategic, more aligned, this doesn't apply. But generally, if you're spinning out that business, you have to do a registration statement ahead of time. So those 8K rules don't generally apply. But on the strategic side, I think there is a small window that practitioners can probably pass through if it is truly strategic, if it is truly aligned with the operation, if there's not a complete board turnover or management turnover, and most importantly, 90% of the stock isn't issued to the new company coming in. Because once you become the accounting acquirer in the transaction, it's a technical term for all the accountants out there. I know you're getting excited. We don't love that term, but it's accounting acquirer. The exchanges look at it. Then you fall into reverse merger rules. And I will say one other thing, and these guys know just as well as I do, when you do an asset acquisition or you do an acquisition under NASDAQ rules, if you're going to issue greater than 20% of your stock and you're going to actually buy an asset, you now need shareholder approval. We learned that in the digital asset treasury strategy when it was just an investment, not even an asset. So I do think that there is a small window to still operate, but it's closing pretty quickly. And God forbid you do an acquisition that looks like anything like NASDAQ has termed the creeping merger. So you issue 20% up front, 10% later, 15% based on something else, and it just looks like a transaction that should be collapsed. NASDAQ will absolutely make you do a new listing application and analysis, and you have to requalify. So they have gotten very, very sophisticated over the years and put a stop to this reverse merger process and saying, hey, look, if you can't do it through the IPO rules, we're not going to let you backdoor it through the reverse merger rules. I'm getting approval from Matt on every question. This is great. Matt, you're on all my panels going forward. You come just kidding. Last question? Or next question? Right here. Benji? Easy. Well,
in your opinion, what separates the companies and their management teams and their company profiles between those that jump in the race and try and access the public markets and those that actually cross the finish line?
That's a great question. Ross, do you want to start? Because I got a great answer, but I don't want to. No, go. We got a great answer. No, go ahead. I got Matt. Yeah. Come on, Steve.
I mean, so I think like one of the things that we find happens often, again, because we end up working with companies that are, call it 12 to 18 months away often from looking to access the public markets. I do think that those that have sort of sufficient scaffolding in place internally makes a big difference. And by scaffolding, I mean things like, relatively mature governance structures, their finance and accounting and reporting functions are relatively well established and advanced. They can conduct a financial close on time. Just like a level of internal maturity across the organization. We do find that tends to be a bit of a difference maker in terms of folks that start thinking about it. Maybe they had the IPO twinkle in their eye, and they bring a bunch of advisors to help them out, versus those that actually get across the finish line. I'm sure that's not the only sort of contributing factor. I'm sure there's lots of fundamental business specific reasons that contribute to it as well. But just like from our perch at EY, I think that's one thing I would sort of highlight.
I think your question really was what separates success from failure in the process. That's how I heard what you said. And honestly, that's not too far off from my answer, Stephen. But I'll say it a little bit differently. I like scaffolding. I may use that in the future. Wrapping resources around the company to make sure you can execute in a timely and efficient manner. The way I like to say it is this: the old days of just being a lawyer or advisor or a banker and going out and just going through the motions of a transaction are over. The SEC doesn't allow it. You have to now chase that. NASDAQ and New York Stock Exchange, as you've heard this whole afternoon, it is a whole another set of rules and problems and professional persistence. So the days of just going through a transaction are over. What I like to equate success to is really having a point person, a quarterback in the transaction. Now, normally in my deals, we play that role. We keep, as we say, the trains moving. So it's no longer people who are processing and just trying to get through a transaction will not get done. So what defines success and failure, especially in the emerging growth space, to me, is having that quarterback in your corner that can go and keep the process moving. Clearly, everyone on this panel is a good quarterback, or for those of you who like basketball, maybe a point guard. You need a conductor. You need somebody to really go out there, wake up every day, whose only mission is to advance your transaction and get you to that next level. If you don't have that, your transaction will collapse under the weight of the regulatory regime, the NASDAQ waiting periods, the back and forth. It will not happen. So for me, the difference between success and failure in this space is really a leader.